Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. Welcome. I am Michael Bull. Thanks for being with us. This segment is brought to you by RealCrowd. For professional crowdfunding, check out realcrowd.com. Well, today we're going to talk about the U.S. office market. The office market has been interesting. A lot of changes in how companies are using office space. There seems to have been a lot of demand for buying office properties. Well, let's talk to an expert. Please welcome Jim Costello. Jim is Senior VP with RC Analytics, and he's joining us on Skype from New York. Jim, thanks for being with us.
Thanks for having me here.
Well, let's talk about the office investment market. Has it cooled down? Has it heated up? What are investors doing in the office investment world?
Cooling is a better word to describe it. Even though we're into the heat of summer, the deal volume has been falling. But when you talk about the office market, right now more than ever, there's much more of a segmentation of the office markets. What we talk about for, say, CBD office markets and the expensive tall towers, trends there are different than what's happening in the suburban world. For the year to date, you're down 25% from last year for deal volume in the CBD locations, only about 9% in the suburban locations. And so there's a couple things driving this. Number one, the declines overall, it's not like 08, 09. I mean, a decline in volume is not necessarily the end of the world. This is just the market reacting to be in a more normal period of deal flow. But it is the case that that's not as extreme in the suburban locations, and I think part of that there is that there's a better yield opportunity. The CBD locations, a lot of them are priced to perfection. And we're also seeing that in just broader price trends with office prices for CBD locations overall down 1/3% on a year-over-year basis versus suburban office assets. Prices are up about 8.5% year-over-year. So there's a bit of divergence in these two markets.
Well, that's interesting. But even with the price increase in the suburban assets, they're still providing a better yield.
They are. It's just structurally, the cap rates are higher in suburban locations. And with that, and given where things have been, the capital continues to flow at a slightly better pace into suburban locations, chasing that higher yield.
Yeah. And you mentioned cap rates. What are you seeing for trends on cap rates now?
It's funny. A lot of folks have been asking me, so have cap rates gone up yet? Have cap rates gone up yet?
Yeah.
Almost as if they're hoping that with the interest rate changes we've seen, the cap rates are suddenly going to shoot up. And there's been a little bit of a creep up. The CBD cap rates are up maybe 20 basis points in the last year, pretty much flat for suburban. But it's a challenge because, yes, the 10-year Treasury has increased sharply this year. And the mental calculus a lot of folks do is they think, well, if Treasuries have gone up 50 basis points, then I have to add 50 basis points on top of the cap rates. But there's not a one-to-one relationship in these instruments. The simple fact is the inflation expectations that are driving growth in the 10-year Treasury, that can help the property market too. Inflation comes with growth. Growth means more tenants looking for space, tighter occupancy, and rent growth. And all that will help to lift property income and increase the value of the assets. So it's not going to be a one-to-one increase between cap rates and the 10-year Treasury. We're at a point, though, where the 10-year Treasury, it's been kind of around the 3% level for a bit. If it goes higher, I think we're going to start getting to a range where there's not as much room for that spread to narrow between treasuries and cap rates, and you'll start to see a little bit more of an increase in cap rates. That's the other reason why deal volume is down, because buyers are, they're really sensitive to this issue. They don't want to be that person that paid the absolute lowest cap rate in the market before everything turned.
And that's why they keep asking you, right?
Right.
So the anticipated improved market conditions, with more tenant demand is really, and potentially higher NOI, is really offsetting the increase in interest rates and not impacting cap rates much yet?
Yeah, well, some. It will impact it some. And back in the envelope, I've been telling folks that I think that for interest rates, if the 10-year Treasury goes up, say, an additional 100 basis points, that might translate eventually to a 50 basis point increase in cap rates. It's not a one-to-one relationship because you get some benefit from the things that drive the inflation expectations that are pushing up the 10-year Treasury that will help property in the end.
Yeah, and even if you do have some increase in cap rate, maybe you have an offsetting increase in NOI anyway, so your asset remains stable in its value. So what do you expect moving forward, Jim? I mean, if interest rates you expect them to continue to rise, and what would you expect cap rates to be in a couple of years?
Yeah, if I knew exactly where interest rates are going to be going, I'd be very, very wealthy. Mm-hmm. The next couple of years, though, I think that the decline we've seen in deal volume, that's something that for a lot of market participants I talk to, this is something new. Frankly, a lot of folks I've been dealing with recently, the last downturn they dealt with was the first downturn they had dealt with. And a lot of folks in the industry haven't had the experience of going through the kind of slow downturn we went through in 2001 after the internet bust, and then also the late 80s, early 90s. It's harder and harder to find folks who worked through that cycle as well. So we're in a period where deal volume's falling, but it's not collapsing. I think this is just a period where we're kind of retrenching to a more normal pace of turnover and assets, kind of time to life cycles of funds. 2015 and that period running into it, that was a tremendous period of growth where the office market was a screaming buy opportunity given the yield opportunities in place. And as deal volume is falling from those historic levels, it's not necessarily a bad thing. It's just a function of buyers and sellers understanding that the market is kind of priced more competitively at this point.
And Jim, where are you seeing the interest from debt and equity for the office sector today? I mean, are some debt and equity considering maybe office to watch out for office, or is it rosy?
Well, the sources of capital on both the equity side and the debt side of the capital stack. On the equity side of the capital stack, you do see a lot of private capital involved today. Some of the big cross-border buyers who were active the other year have pulled back, the Chinese notably. Although there is some activity from Chinese investors still at a more reserved pace, and there's a few examples in other property sectors where they've done deals in the year. But it's not like it was in 2015, 2016 early, when they were paying top dollar for a lot of CBD office assets in the New York area. But that kind of change on the equity side, it cools the market a little bit. On the debt side, it's a very competitive lending market. There's a wide variety of capital sources active in the debt portion of the capital stack. The one segment that I think that people are a little concerned about are the so-called debt funds. And one of the issues there is that the debt funds have some have lines of credit from major banks. Others are just kind of lending off of equity that they've raised. And it's kind of opaque. There's not as much information about where the capital is coming from. And the regulators I talk to in particular are always worried about that, because if you can't see it, you can't manage it. And that's the thing that they get concerned about, because they've been coming in with much more competitive debt in terms of providing higher LTVs. And they've been making a lot of inroads on the construction side of lending in particular.
We're talking with Jim Costello, Senior VP with RC Analytics, about the office market. So Jim, what should office owners and investors think about today? What makes them nervous or excited, or what should they think about?
The things that make them nervous are the health of the cities that they're looking at and the locations. Do they want to chase the millennials and find office space that they think that those tenants are going to want to occupy over the next 20 years. If they do that, do those people pick up and move? Because they don't quite know, where that labor force is going. Those kind of issues have generated some concern. Finding good yield opportunities continues to be always on everybody's mind. And there's a little bit of concern in a few markets about construction. There's a handful of markets that have seen some major towers go up, and that's got some people cautious. Obviously, it's nothing like the late 80s, early 90s type construction, but in a few pockets, there are concerns about what's been happening.
And any concerns about tenants using less square footage per employer, or any changes in kind of how tenants use space bothering office investors today?
The one thing that I've seen recently that people talk about in terms of, this has been a topic of discussion my whole career of reducing the use of office space by more technology instead, and co-working and everything. But actually, the co-working phenomenon of late, that's been particularly interesting, thinking about the end of the type of sublease market that used to exist. If you were a startup in the past, you could get a sublease for 6 months. You still can, but the option of going to a WeWork and having that co-working type location it provides a certain level of flexibility that wasn't there before, and I think that's eliminating the optionality for tenants to kind of unload space, and that creates a slightly different dynamic for property income.
Yeah, that's an interesting aspect to think about. Well, what's positive for office owners? I would think the robust economy and full employment. Are office investors excited about that?
Yeah, full employment is obviously good in terms of being able to have properties filled. Frankly, I think one challenge with that is generating growth. How can you add more workers? If you can't find the workers, you can't fill the space. And that's a problem in some cities recently with workers finding the cost of living to be too high. Look at Silicon Valley, where I think everybody's seen the pictures of the camps where Google engineers are living in RVs. If I'm looking at office space in Silicon Valley, and I know that some of the highly paid workers can't live there, it makes me wonder if I have to think about alternative locations as well, where the workers may start to migrate because of a better work-life balance.
Yeah, and HQ2. So where are they going to end up? You have that in your crystal ball. You probably know that there in your office in New York.
Well, I tell you, my money is on Northern Virginia, and as I say that, I don't actually have any money on it. I haven't placed any bets on it, but I think Northern Virginia. There's a couple reasons for that. There's a classic study by a fellow named White who had done some work looking at corporate location issues. One of the key factors, the two key factors they identified, was where does the CEO play golf and where's the CEO's home, and those two would determine where the corporate headquarters would be located. And the home that Jeff Bezos has been building in D.C., kind of renovating two homes in the same neighborhood where the Obamas are renting right now, and building a lot of luxury amenities into this building, that's a telling indicator, his connection to the Washington Post. But then also the politics of it, because if he locates this in the D.C. and Maryland area, suddenly you've got tens of thousands of workers tied to Amazon, and 4 senators that with connections to Amazon as a result. And the politics of operating in D.C. and being able to navigate the regulatory waters, that might help them more.
Yeah, well, I laughed when you said that about the CEO, because we used to say that years ago. I've been in the business for a long time, that we do all these analytics, and then ends up going to the office building that's closest to the CEO's house. But
Right.
Obviously that's went out the window, and people are really concerned about recruiting and retention and productivity, and really do think about their customers and their employees, I think a lot more than they did, 10 or especially 20 years ago. Well, what would you leave our audience with, Jim, today related to the office investment world?
Yeah, the thing I've been leaving folks with, I touched on this a little bit, deal volume is down, but the sky's not falling. It's just an adjustment back to a more normal period where for every deal, buyers and sellers are going in with cautious expectations. We had a very high period of deal volume growth when it was a screaming buy opportunity to get into the office market, given the high yields and the low rates of return on bond instruments. That opportunity has been narrowed, but there's still an opportunity. It's just something more like what was a normal opportunity, where buyers and sellers are always just a little bit further apart. So it's a harder world for a lot of folks to operate in, but it makes brokerage activity more valuable at this time.
Yeah, well, there you go. Well, Jim, great information as usual. Thank you for joining us.
Thank you.
If you'd like more information from Jim on the office market, check out RC Analytics. And stay with us. We'll have more on the U.S. office market after this quick break. I'm Michael Bull. This is America's Commercial Real Estate Show.